Thanks, David. Thanks for having me on. And to give you an introduction, we are Blue Line Futures, a futures and commodities brokerage firm that provides you with actionable research, state-of-the-art technology, and full client support to give you every possible tool you need to tackle the markets. Breaking down the presentation, I want to give you an overview of my background, my day-to-day process, the benefits of trading futures over other investment vehicles, as well as some technical analysis tools, and most importantly, our fourth quarter outlook and key commodities we are watching. Now about Blue Line Futures, we put the customer first, bringing you dedicated customer service, consistent and reliable proprietary research, and state-of-the-art technology. Our trading solutions fit all sizes and shapes. You could be new to futures trading and want hands-on help, or you might be looking for education to learn how to trade futures and options. And where I work with clients most is idea collaboration, someone you could bounce ideas off of from time to time. We also cater to self-directed traders and professionals looking for a low-cost solution. It is our goal to provide research that is unmatched anywhere else. Our clients have free access to our flagship report, the Blue Line Express, that gives you an in-depth rundown of each commodity we are tracking, along with any current directional bias or strategy. As the day unfolds, so does our market analysis. We are keen to provide you with the most cutting-edge service and ideas so you can exploit our thesis. To let you know a bit about myself, I began my career 20 years ago after graduating with a triple major in finance, marketing, and economics from Purdue University. I always knew I wanted to help people in the investing arena, and upon graduating, I was recruited as a financial consultant with A.G. Edwards, where I helped build wealth management solutions for long-term investors. However, in 2002, something in the markets had changed. The tech bubble had burst, and the new commodities super cycle was just getting underway. This is similar to what we are seeing right now. So then I took a role at Lynn Waldock and teamed up with some of the brightest minds in the industry and went on to run one of the largest metals and energy trading desks. In the fall of 2011, I had transferred my skills to RJO Futures to expand my footprint in the agricultural, livestock markets, and softs markets. Bringing all of that together, I reconnected with some of my favorite and most respected colleagues from the past and joined Blue Line Futures. In addition, I've been a frequent contributor on CNBC, Bloomberg, Fox Business, and also Kitco News, where I regularly write weekly commentary on the precious metals markets. Now, many of you are experienced in the basics: stocks, bonds, mutual funds, ETFs, and precious metals. What we do at Blue Line Futures is help you take the next step and bridge the gap to learn how to trade futures. So why trade futures? Futures provide a fast and cost-effective way to access financial and commodity markets that are simply easy to understand. And with increased interest in the global markets, changes in geopolitics, and now supply chain constraints, it's simple and easy using futures nearly 24 hours a day to take a directional bias and begin to speculate in commodities such as energies, precious metals, agricultural markets, financial futures, soft commodities, and even livestock. The biggest benefit of futures trading is cost effectiveness, of being able to utilize leverage. And with a wide range of contract sizes, they have now made it possible for traders of all sizes to manage their risk and build out positions that match each individual's personality and risk temperament. So the most asked question I receive from a beginner is, how does it work? And what they're asking really is, how does leverage work? Is it appropriate for me? A quick example with leverage using one of our most popular contracts, and often a starting point for many investors transitioning over to futures, is the 10-ounce micro gold contract. How many of you have collected gold or silver coins with the idea that you're trying to hedge price inflation over time? I know I did. So the gold and silver futures contracts are oftentimes an easy way to begin or a starting point when getting involved with futures. The E-mini micro gold contract is conveniently sized and tailored to individual needs at 10 ounces per contract. And with gold trading right around $17.50 per ounce, A 10-ounce gold contract has a total value of approximately $17,500. You get that by taking 10 ounces of gold and timesing it by $1,750 per ounce. Now, the current margin requirement to control 10 ounces of gold is only $908, or about 5% of the contract value. So for less than the cost of one American Gold Eagle, an investor can open up an account and effectively control 10 ounces of gold. Now, futures trading is all about maximizing your capital, and the leverage allows you to utilize your capital more effectively and efficiently. Looking at a quick example, say someone wanted to speculate in the direction of gold. You have multiple investment choices you can make. Now, for this example, we used $52,500 worth of gold as an example because our latest blue line strategy note, gold was trading at about $1,750 an ounce. And we discussed scaling into 3 micro gold contracts at key support levels, buying one right here at $1,750 an ounce, buying another on a decline at $1,725, and our last contract down at $1,690, all with a protective stop loss down at $1,640. Again, for access to our strategies, please subscribe to the Morning Express research note. But getting back to maximizing your capital, what options are available to someone trying to replicate the strategy without utilizing futures? Well, someone could commit the capital outlay of $52,500 for 30 ounces of gold into a proxy product, such as an ETF like GLD. The drawback is you have all your capital tied up and you can only enter and exit the market during regular stock market hours from 9:30 a.m. till 4 p.m. when typical trading takes place. Or let's say you went on and you tried to apply and get approved to have margin and you receive leverage on the equity side. Well, the most amount of leverage they can offer you is 2-to-1, still leaving you with a sizable capital outlay of $26,250. Now, 2 other markets that people really look at, and one specifically is the physical market. Now, I'm a big believer in gold and silver coins, and I believe everyone should have some gold and silver tucked away. But the problem is, if you buy a lot of physical gold or silver, the issue you might have is liquidity. Let's say you buy silver coins or gold and the price doubles on the debt ceiling concerns, or another pandemic, or simply a targeted short squeeze like what we've seen happen in silver in the past, or natural gas right now in Europe. It's going to be very difficult to unload your gold or silver in a timely manner and try and capitalize on it. So let's focus on the futures. When you buy futures, you are only required to post the margin requirements. And with $908 required to control 10 ounces of gold, you can easily control the 30 ounces, $52,500 worth of gold for a mere $2,734. You get that by taking the minimum margin requirement, $908, and timesing it by 3 and funding it with a small cushion beyond that margin requirement. So you're able to deploy your excess capital into other investments or diversify across multiple commodity sectors. Many investors choose products to hedge inflation, such as a 1,000-ounce silver contract, 500 barrels of crude oil, or 1,000 bushels of corn, wheat, or soybeans. You might even want to hedge your stock portfolio with micro index futures, especially with stocks at near all-time highs, and also volatility increasing. Now that I went over some of the benefits of leverage, I'll take you in a simple step-by-step process using technical analysis, and then finally cover some of our highest conviction fourth quarter calls that you don't want to miss. Now that you understand some of the benefits of futures, we're going to jump into the second part of the presentation on technical analysis. Have you ever heard the saying that the trend is your friend? Well, what we did was we created an ebook called the 5-Step Technical Analysis Guide to Gold that helps you become a master of the charts. You can apply these steps over any market. So let's quickly go over that process. What we did was we wanted to develop a framework for you to follow. So the step one is really identify the trend. Is it a bull market? Is it a bear market? Are we traveling sideways? Step two, identify the key levels of support and resistance. Step three, have a simple entry and exit strategy. And then step 4 and 5, use pattern recognition to add positions and risk management. So looking at the trend line chart, one of the first steps, again, to becoming a master of the charts is to identify the trend. The trend line is one of the most basic charting tools. The key is to look for 3 tests of support to indicate the market is in a strong trend. If the market breaks through a trend line, it can also be an important signal that the trend is coming to an end. Now let's look at the price of gold. Where have we been and where are we most likely going? Gold's bull market that peaked in 2020 had actually officially began in the third quarter of 2018 when interest rates and GDP had peaked. This marked the top of the business cycle and the low in gold futures, right at about $1,050 per ounce. Since many investors missed that opportunity of buying gold down to the $1,050, our new reference point that we're using for charting purposes is effectively the March 2020 lows. This was the height of the pandemic and also the beginning. It was the point that the Federal Reserve had aggressively cut interest rates, and the Treasury Department began their latest round of relief stimulus. These measures are taken to inflate asset values within a declining economy. So you're saying inflation rise and growth decline. This is often called stagflation, and it is also the best economic time to be long and have exposure to the gold market. You can see this cycle had peaked in August 2020. And then since then, over the past 18 months, gold has gone through multiple cycles of mini bull and bear markets. Shortly after the peak, the rollout of the vaccine would help shift the economy into a forward-looking growth cycle. That allowed other asset classes to rise, such as energies and US equities, causing a rotation out of gold and into the reflation trade. Now, gold will go through another cycle change when a reemergence of the Delta variant had occurred. But shortly after bending those curves and the reflation trade picking up steam again, that pressured gold until about today. We believe that this will come to an end, this sell-off, as the new year approaches, and I'll tell you why a little bit later. Once the trend line is drawn on the chart, a retracement, which is oftentimes used for risk management, is a significant price adjustment to an existing trend. Traders commonly focus on Fibonacci retracements, and the 3 primary levels are 38.2%, 50%, and 61.8% of the prior move. Now, we're not going to get into all the complexities of Fibonacci analysis. I really just want you to know what these levels are and what price coincides with them in the market you are trading, because oftentimes they are levels that act as gravitational pulls. A 2-day close through one retracement level can signal the next move could be changing directions. When a market closes below the 38.2% retracement in a declining market for 2 consecutive days, we will often see a quick move down to the 50% level because so many professional traders are watching and trading based upon these levels. Now that you have identified the trend and have a basic risk management process, you got to have a trigger. And one of the simplest ones is the moving average crossover. The moving average crossover is one of the most fundamental trade triggers that professional traders use. It provides a trading signal when a shorter moving average crosses above a longer one when the trend is up, while the opposite happens when a shorter moving average crosses below the longer one, the trend is down. This may seem complicated, but once we walk through an example, you will see why so many traders use this technique for entry and exit points. Since gold often trends for more extended periods of time due to slower changes in economic conditions or the many months it takes for the Fed to change monetary policy, traders often use longer-term moving averages to generate their buy and sell signals. It's no coincidence that one common strategy called the Golden Cross that is an example that began in 2019 and concluded 2 years later in early 2021. The Golden Cross occurs when the 50-day moving average, the green bar, crosses above the red bar, the 200-day moving average, indicating that the longer trend is moving higher. Conversely, the death cross occurs when the green 50-day moving average crosses below the 200-day moving average, indicating that the longer-term trend is shifting lower and conditions in the underlying asset are deteriorating. Now, one of my favorite strategies for active traders looking to add to positions in bull markets is the trading range breakout. A breakout occurs when the market is contained in a congestion zone for some time. We are showing a daily chart pattern that will illustrate longer-term trends, but you can always shorten the time horizon or change to a 60-minute, 15-minute, or even a 5-minute chart for active short-term trading strategies. These types of breakouts you might see visible in chart patterns include pennants, flags, and triangles. The basic strategy is to buy or sell a breakout to one side with a stop on the other. Now, really having an understanding of basic technical analysis can help you to understand the psychology of price movement and is one essential tool in every trader's toolbox. So let's move on to the fourth quarter outlook, and I could give you some of the trading ideas to monitor moving ahead. And maybe it can help point you in the right direction, identifying some of the markets that you can associate with and trade. So as we head into the final stretch of 2021, after a very volatile third quarter, the reflation trade remains intact. We should continue to see broadening inflation with seasonal tendencies in the market. The recent rebound in the dollar index and the rise in real interest rates within a short period of time led to a swift decline in the gold market and many other commodities. However, one must ask themselves, and many clients and prospects call in asking this very question, is this rally in the dollar and interest rates for real? Our analysis makes us believe that the dollar will fail again at the upper band of resistance. And quite frankly, now that you start to see commodities rise, they don't believe in this dollar rally either. The Fed is currently trying to tighten to curb the impact of higher inflation. However, the Fed cannot resolve logistical bottleneck supply constraints or unfavorable growing weather that has led to this food inflation. And finally, the pent-up demand from the economic reopening. So these markets we have identified as having the best potential for the fourth quarter. The first one, coffee. The bullish catalyst for coffee continues. Since forming a multi-year high over the summer, since then, prices have pulled back. They're digesting the effects of the severe frost that led to extensive damage in Brazil. Many of the farmers down in Brazil had to completely uproot their coffee plant, leaving multi-year cycles where production will be lower. The expectations indicate that over a quarter of the production has been lost and will take multiple years to recover. While supply chain constraints simultaneously prevent a steady flow from Vietnam, which is the second largest producer. We firmly believe that the reopening trade is in the beginning stages, especially in Europe, where prices could easily challenge those 2011 highs, giving another 50% upside potential. Now, the second market, which we've discovered in great lengths throughout this presentation, is the gold market. With the trend turning lower, one would be openly discouraged from making a bullish call after that run to all-time highs in August of 2020. And the hardened resistance that we've seen recently from 1820 to 1835 has also stopped gold in its tracks. The bulls have repeatedly been knocked down. However, I do not believe that they are out for the count. Although the Fed has openly done an excellent job of presenting their tapering case and will most likely go through with it, the problem they will face as early as December is the same mistake they made back in mid-2019. What they did was they went into a tightening policy, into an economic slowdown, which eventually led to a disaster. A pause in rate hikes could lead to a breakout at 1835 and another potential run to 2000 in the year 2022. The third market we're very focused on, crude oil. Now, is it just me, or is it getting more expensive to fill up your gas tank? Besides Goldman Sachs making a $90 year-end call, China's vice premier ordered top state-owned energy companies to secure supplies for the approaching winter at all costs. Additionally, current EIA inventories are sitting at 418 million barrels, and they show a widening production deficit from the 5-year average of 450 million barrels. This leaves us with a yearly change of a loss of 73 million barrels. This supply deficit continues to widen. Our projections are calling for $85 crude oil by year end and triple digit if something structurally doesn't change into early 2022. The fourth market, platinum. This is the one that everybody is keeping an eye on. Everyone knows about the chip shortage that's out there and how it continues to weigh in on US auto inventories. Car lots are near empty, and we have record high prices for used cars, showing that the demand is there. The car lots that are out there are mainly filled with just that, used vehicles. There are no new vehicles being produced, not anywhere big in the United States. And the reality is that the supply chain bottleneck will get sorted out when the chip makers and new car production comes on to meet demand, and that's going to explode. With 2022 right around the corner, automakers will be halting production to push for new year deliveries, and that will cause the seasonal low in platinum, like what we've seen in the past 8 out of 10 years. Platinum futures could easily punch through $1,000 an ounce and run from there. And finally, wheat. Dry conditions in growing regions have resulted in sharp declines in wheat production. And with food inflation on the rise, governments globally are scrambling to restock inventories. End users have had an equally challenging time securing inventories, forcing them to pay at all costs. The global demand is stronger than expected, and wheat prices should continue to rally well into early 2022. We believe that any pullback is a buying opportunity with $8 plus wheat on the horizon. Now, I limited this list to just 5 high conviction real assets to keep your eye on. However, we strongly believe that many others will benefit and potentially outperform, such as silver with the Green Energy Initiative, or sugar with ethanol demand picking up due to rising energy costs. Cocoa is another, threatening multi-year highs. And don't forget about the seasonal tendency for the Dow Jones to rally from the last week of October into the early December. Now, I hope you enjoyed my presentation. And if you would like to know more about the strategies in futures and commodities markets, please register for a free 2-week trial of our research at bluelinefutures.com. And thank you very much for having me today.
Okay. Do you want to take some questions? If anyone has any?
Yeah, if anyone has any questions, I'd be more than happy to answer them.
All right. So any questions for Phil? Just go ahead and type them in the chat. Okay, are you able to see the chat? Someone asked, is now a good time to invest in gold?
So right now with the gold market, it's been selling off because of the recent rally in real rates. Real rates have been negative for quite a while now, and they've snapped back sharply. That in anticipation with the labor market recovering and the Fed currently set to taper, gold futures have been under pressure. The problem is that gold futures can change at any point in time. We saw how the Evergrande, just within 2 weeks, had really caused a panic in the markets, and that really set things off, as well as the debt ceiling currently that they're negotiating. They've made some progress on, but we're going to run into those challenges again. And we're not completely out of this pandemic, or we haven't completely reopened. So it's easy for gold to snap back and run back higher. What we recommend is not committing all to gold at one point. It's to coming up with a specific level that you would be comfortable with on allocating some funds to the gold market. That's why we identify the 10-ounce gold futures. And what we do is we try and buy on the corrections going down small enough increments in order to get your average price as low as possible, and also have it at a manageable risk to reward state. So when the year-end rally does begin and we go into the next quarter into 2022, what we think will happen is that the growth market, the GDP market has already, the GDP economic data has already peaked. So growth is going to start to decline the farther out you go. As the Fed tries to raise into that declining growth, what you'll see is people will exit the US equity markets and they'll look to park their money somewhere else. We believe that we'll go into either a stagflation or a deflationary type event. And those are the two best market cycles that gold works well in, specifically the stagflation market. Deflation, gold mainly works as a placeholder. We know that this equity run, bull run, it could go on for a while, and it looks very good right now. However, the farther out you get, the tougher the challenges are.
And another question was, what is your view on QQQ?
Okay, QQQ, the NASDAQ is one of the best performers specifically when yields are low, right? Because most of these technology companies, what they do is they borrow capital in order to fund their expenses, their growth. So they rely quite heavily on interest rates. With the Fed coming out and with the tapering and that snapback, you'll see there is a parallel between gold and the NASDAQ. They both corrected as rates went up. Other stock indices like the Russell 2000 and the Dow Jones, they operate a lot better in rising interest rate environments because of their exposure to the financial sector. What we believe is that because of that slowdown occurs, the seasonal tendency kicks in, the Fed is trapped where they can't raise rates so fast, not as close as what they do. We believe that people will continue to find safety in large cap mega technology growth companies. So we are very bullish on the NASDAQ. We believe that our models show that the NASDAQ, the S&P, and also the Russell should go on and signal new higher highs in the market. So you really want to stick with the NASDAQ when you have that growth cycle and you also have that stagflation cycle. you start going into rising interest rates, you're going to have to rotate out into the Russell, into the S&P, and into the Dow.
Someone else asked, how do I open an account at Blue Line?
It's very simple to open up an account at Blue Line Futures. You can go to BlueLineFutures.com. You could click on the open an account link. We have specialists that'll help you walk through the account application. It takes about 10 to 15 minutes, and we can open up an account anywhere where you're at, basically in the world. Anyone from Canada, Europe, South America, Asia, we operate and we help assist all those traders.
Do you prefer Minneapolis wheat over other wheat markets?
Okay, so the
Another
wheat market is very interesting. If you look at the different wheat contracts, the area of the country that was most impacted from the weather, we mainly had this very hot, dry summer that really affected the northwestern part of the United States. Your leading indicator, in my opinion, on the wheat market has always been the oat market. If you pull up a chart of oats today, at one point it was limit up. It had taken out the price of corn many months ago, and we saw this transition occur where wheat futures had gone basically exponential. Oats and wheat, again, very similar on their chart patterns. What we're seeing is this smaller Russian crop. We're seeing end users continue to scramble to secure production to meet constant and rising demand right now. And with food inflation on the rise, we believe that wheat is the area where you want to be in.
Okay. Any other questions for anyone? All right, I think that's it. So.
Well, thank you very much. Thank you for having me, Dave.